day, everyone, and welcome back to the premium video newsletter for September 11th, 2013. This day brings back lots of bad memories for most Americans, and it seemed like only yesterday that we had the 9/11 terrorist attack. But America always gets out of a tough situation, and we're doing it again with the economy as we speak. So let's start off with the fundamentals and work our way down from there. The markets were trading on mostly technicals today, and it was the first day that we had some divergence between the major indexes. Traders are focused on the upcoming Federal Open Market Committee meeting on September 17th and 18th. Analysts believe the FOMC will scale back their quantitative easing program in spite of last Friday's disappointing non-farm payroll report. The consensus view is that the Feds will scale back their quantitative easing from purchasing a total of $85 billion of treasuries and mortgage-backed securities every month by $10 billion to $75 billion per month. Technically, the broad market was fairly strong today and rallied to close for the sixth higher high in a row. This is very impressive, especially for September, which is not the best month for the stock market. The RSI is getting closer to overbought levels, but we're not there yet, and the fact that we closed at the highs gives us a fairly high odds that we're going to be opening higher tomorrow as well. There is some major resistance at the 1700 area, and I want to see if we can maintain enough momentum to get there. Tomorrow and Friday's fundamentals are going to be the big focus, and I want to see how we react to that news. If we shrug off bearish news tomorrow, my confidence in this market will be increased. As you know, I'm skeptical that this market can maintain new highs right now, but with the Feds throwing money into bonds, it's hard to say how much of the move is real and how much of it is supported by the Feds. For now, I'm still bullish till about the 1700 level. The analysis for the NASDAQ market is a bit more difficult because we have two interesting developments. First, we have a new high. In essence, there's really no other bullish indication that's more powerful than a new high in an index. So we're obviously in a bullish cycle right now. The bullish flag pattern that we broke out of is also indicating further upside. But there's another technical development that we have to be mindful of right now in the NASDAQ. As you can see, we're beginning to show significant divergence between the RSI and the index. I use the RSI instead of the stochastic indicator most of the time for overbought and oversold levels because it's not a very sensitive indicator, especially when compared to the stochastic indicator. So I have a lot of faith in it. Also remember what I've been saying the last few days. The NASDAQ is a big index, but it's nothing compared to the S&P or the broad market, as I like to call it. And we're not seeing new highs in the broad market just yet. I'm also seeing a lot of resistance in the broad market, and we've been making highs for 6 days straight. So expect some downside in the NASDAQ during the next few sessions, especially if the broad market begins to weaken, and it looks like we may be there in the next few days. One of the reasons why we saw a bit more weakness in the NASDAQ instead of the broad market is because of Apple computers, which dropped like a rock today after the company announced a cheaper version of the iPhone. I remember just 1 month ago when billionaire Carl Icahn was tweeting about Apple stock being too cheap. I warned you that these type of announcements don't cause momentum to continue very long. And remember the most important thing I always say, markets revert back to their trend. The US dollar continues to decline as we've been anticipating during the last few days. Last week and beginning of this week, the economic news was not as good as US had expected. Basically, things are better but not good enough for the US to stand on its own. This is what the dollar is reacting to today. And unless we have very positive economic news tomorrow and Friday, I believe we will continue seeing softening dollar prices. If the threat of war increases once again, the pressure to sell the dollar will increase even further. Right now, look for a soft landing at the 81 level. A few days ago, I did an extensive analysis of the British pound, and today we broke out to a new high. A report showed UK unemployment fell to 7.7, which is the lowest level since last year. This compares to an estimate of 7.8, which is just slightly higher. The Bank of England previously set an unemployment target at 7% as a threshold where the central banks would start thinking about increasing interest rates. If this trend increases and interest rates go up, money will start flowing out of the dollar and into the pound. Now pay attention to this. This is similar to the situation that we're having with the interest rates and the US dollar in the States. If the stimuli program ends, interest rates will get higher and money will flow into the dollar. If interest rates don't go up, then money will flow out of the dollar and into a country with higher rates. And this is what's happening right now with the pound. I'm expecting much of the rise or the fall of the pound for the next 2 or 3 sessions to be extremely dependent on the dollar and the strength of the US bond market. Let's see how the economic news comes out tomorrow and Friday. If the US economy is strengthening and the dollar goes up tomorrow, we will see weakness in the pound. And conversely, if the news is negative tomorrow, the bond market will rally and the dollar will decline, and we will see another rise in the pound. Let's watch the night session and I will update you tomorrow with the numbers. The Australian dollar had positive GDP numbers come out, and today we saw the consumer confidence increased to the highest level since December 2010, which is a pretty big deal. Technically, the Aussie had a double bottom pattern that we spotted a while back. Also notice that the second bottom is higher than the first bottom. Many trading books don't tell you this or tell you that it doesn't matter, but I only trade double bottoms when the second bottom is higher than the first bottom. I don't consider a pattern a double bottom if the second bottom is lower than the first one. For now, watch the 95.5 level as the near-term resistance level. I'm expecting some selling to begin right around that level. Generally speaking, the way to measure the profit target from a double bottom is to measure the distance between the second bottom and the breakout point and add that to the breakout level. In this particular case, the distance between the second bottom and the breakout level was approximately 3,000 ticks, and the breakout level was at approximately 92. So if you add 3,000 ticks to the 92 area, the profit target is determined to be around the 95 area, which is very similar to the level we extrapolated by looking at the chart itself. This tells me that we're fairly accurate in our analysis from 2 different perspectives. There's only one setup for tomorrow, and it's a 4x4 to the downside. The ticker is NTRS, and the name of the stock is Northern Trust Company. Place a sell stop 20 cents below today's low, and if filled, place a buy stop 15 cents above today's high. That's it for today's tutorial. Tomorrow we should see some volatility in bonds, so watch out for that. I will update you midday as usual. Have a great night, everyone.